Thanks for joining us. Still have some people coming in, but I think we should get started. We only have an hour today. So let me welcome my friend Ricardo Bayon to the room, and really looking forward to this conversation. So thanks for joining us, Ricardo.
My pleasure. Always a pleasure, John.
We just traded. I was just up at Brown doing a reverse of this just recently, so I'm seeing a lot of Ricardo recently. So Ricardo is an ecologist by training, who's become a financier, and I'm a financier by training, who's trying to become an ecologist. But Ricardo is also a founding partner of an investment firm called Encourage Capital, which is an impact investment firm currently with a fund focused on solar development in India. He's also an adjunct professor at Brown University, teaching a course on finance and the environment. And most particular for this conversation today, he's an expert on carbon markets and increasingly the challenge of extending the concept of carbon markets to ecosystem services more broadly. And Ricardo and I have a fun what's the right word, Ricardo?
History.
History, but it's odd that the ecologist has in a sense gotten involved in using financial markets to address ecological crises, and I've become quite cynical and critical of financial markets as a way to address all of our problems. So we're sort of switching hats and have had many fun debates over this, and ultimately agree. But we're going to be on different sides of the debate if there is a debate here today. So you'll see as we evolve. But
Refer
anyway,
to
let's jump
it
in.
as us meeting in the middle,
We're
John.
meeting in the middle. Yes, both end. Um, is there anything else you want to tell us about your story, Ricardo, that I didn't mention in my biography that would be pertinent to our
Yeah.
conversation today?
No, I think all I would add is that, I worked for the beginning of my career in conservation and trying to protect areas and using the ecology and, was very involved in the Rio conference, worked at IUCN, the World Conservation Union. I was working to literally protect landscapes, and it just felt wrong to see how we were struggling to spend tens of thousands, if we were lucky, hundreds of thousands of dollars to protect a landscape. And then somebody was coming in and spending easily several billion dollars to do something that would totally
To
destroy
destroy
it.
it. Yeah.
And my thought was like, what's wrong with our system that it's so easy to pay billions to destroy something that we will not even pay tens of thousands to protect? And so I
Mm,
started focusing more on how to change the flow of money.
mm. Beautiful. Yeah. Which explains why we're going to be on the opposite sides of the debate from time to time. So I totally get that. Well, let's just to make sure we're all kind of level set here. Let's jump into just really some of the very basics, if we can. So what are carbon markets? And in particular, if you could just describe the distinction between offsets and allowances, and just give us a rough sense of what this is all about.
Yeah, so let me start a big picture and why I think these things are interesting. And why I think they're interesting is because one of the main problems I see in our economic system is that it is blind to all of the benefits and values that nature provides. All of these beautiful benefits that we get from working landscapes do not show up on people's balance sheets. And since people's balance sheets help determine people's decisions in the system we live in, these things don't get taken into account when decisions are made. And so, by extension, their value in our economic system is zero. And I don't know what the right price is, or even if there should be a price, but I know zero is the wrong number. And so, I've spent my entire career trying to figure out, can we change that somehow? Can we send the right signals to our economic system? Because I do think actually our economic system is a very powerful tool. It is broken in many ways, but it has also delivered a tremendous amount of value to societies going back into, thousands of years. So how do we fix it? How do we patch it? I'm not against throwing the whole system out and rebuilding it. I'm skeptical that it'll happen in my lifetime. And so in the meantime, what do we do? And so I see carbon markets as an interesting experiment in how to put a value on these ecosystem services. How, if you want to get economically technical, it's how to internalize these externalities, right? And it's a fascinating experiment that I think we should all be watching, whether we love it or hate it, we should see how it turns out.
Mhm.
And to explain more, carbon markets, I think it's important to
Sorry,
understand.
just let me back you up for one quick second.
Yeah, yeah.
Just explain, just so everyone knows, what is an ecosystem service?
So, our economic system puts value on the products of nature in lots of different ways. So, right, like we know what the price is of wood, we know what the price is of corn, or, if you want to go into financial markets, corn number two or whatever, or oil or what have you. But living ecosystems deliver value too. And those values come in the form of a variety of different services, right? Clean air, clean water, atmospheric regulation, fertility, pollination. You can go list a lot of them. And our economic system often is not very good and is terrible at putting a value on those. And so they don't show up in our balance sheet. And I like to think of it as it's a problem of the operating system. So we built this operating system, this economic operating system, hundreds of years ago, when what was scarce was capital and labor and not natural systems and natural values, right? Like those were the swamps that needed to be drained. Those were the problems. That was, we're never going to get rid of all those bison, millions of bisons on
Mhm.
the plains. It was a different era. And
Mhm.
now we're moving into an era where services are actually becoming more scarce. And I
Mhm.
see that the real interesting thing that's happening is that scarcity drives value. And we've understood this for many, many decades. Scarcity is what drives value in our economic system. And as they become more scarce, there's going to be mechanisms to put value on them. And that value is going to go from zero to something greater than zero. And
Mhm.
what are the ways and the tools to do that, particularly when what we're talking about are, not necessarily private goods, they're common goods in lots of different ways and common services in lots of different ways. So government and policy has a role to play in how these ecosystem services get valued. And we can talk a lot about that. And actually, the carbon markets themselves are an interesting example of how that is happening and how that may be happening going forward. So let's going back to the carbon markets and the question you asked, it's important to keep in mind that there are two types of carbon markets out there. One is a regulated carbon market. This is driven by government policy. And, the examples of that are the EU emissions trading system or the carbon market in California as two examples of that. Um,
Probably the two largest, right?
China's probably larger than California now,
Wow.
but yeah, the EU ETS is certainly the one of the largest, if not the largest. Um, and the way those work is what they call a cap and trade system. So government says we're going to set limits on emissions. And we're going to gather the people who emit and we're going to sit them around a metaphorical table and we're going to say, all right, you were emitting 100 tons. We're now going to lower your limit to 90 tons. If you emit more than your 90 tons, and this is an allowance to emit that the government gives you, or you buy from the government. In some systems, you can buy them from the government. If you emit more than you have allowances for, you will either get a massive fine from us and the government, or else you have to buy from somebody who is emitting less than they have allowances to emit. So it creates this nice incentive to emit less and disincentive to emit more because all of a sudden every ton you emit has a value. And you can either pay it or get money from it if you don't use it. Um, And, cap and trades were born in the US in the sulfur dioxide trading system, which was the first of its kind. And sulfur dioxide was used to address the issue of acid rain, right? When sulfur dioxide gets emitted from coal plants, it mixes with water and oxygen and creates sulfuric acid, basically, that falls in rain form. Um, the sulfur dioxide trading system worked. It is the reason we don't talk as much about acid rain now as we do, on top of the fact that we're using less coal. Um, and so people started saying, well, we should use something like that for carbon. And that's where the carbon markets were born. So anyway, the regulated markets, government sets a limit on emissions, allocates allowances to emit, and then companies and others that are emitting have to meet those targets. Um, in a way, people often say, well, shouldn't we just tax carbon? And I think, yeah, in some cases we should. That's another way to put a price on carbon. The benefits and the differences between a carbon tax and a cap and trade are interesting in the sense that a tax gives you certainty of price without certainty of result. So let's
Hmm.
say we put a tax and say it's $10, right? That number may be too high, too low, too high, and it discourages productivity, and energy is everything in our economy. Too low, and it's not going to achieve any reductions in emissions. Cap and trade is the opposite. It says we want to hit a target. This is our target. Now the market goes out and decides what the price is to hit that target from the covered sectors. Um, so,
To understand cap and trade the tool is the quota. And it's
exactly.
interesting we don't use that word because it sounds socialist or communist or something, but it's a quota. And talk a little bit about how for the established markets, at least maybe just talk about Europe or whichever one, just not to get into the weeds too much, but like how do the policymakers we're well past we're already past 1.5 degrees, racing to 2 degrees. The forecasts are will be at 3 degrees. So how do we think about the question, what's the right quota when we're
Mhm.
already past where we need to be?
Yeah, so, I'm not going to get into the how many angels on the head of a pin kind of discussion here, but I think the right quota at this point, where every sort of system is moving the other way, it's not like we're going towards a system with greater regulation on carbon emissions. In this country, we're
Right.
going the opposite direction. So for me, any quota that lowers emissions is the right direction.
Hmm.
I would love it to be higher and more. But
Hmm.
if you look at California, for instance, and Europe, all of these quotas are ratcheting quotas.
Yeah.
So they're getting smaller and smaller every year that goes by, right? So the idea is to drive that transition in bigger and bigger ways. And there's a system, and every so often, the quota gets ratcheted down and then ratcheted down and ratcheted down. So it's a tool for achieving the decarbonization.
And when you say ratchet it down, that's already in the legislation. It's
It's
not that
already
they get together next year and decide. It's actually built into the mechanism, correct?
In the case of California, it's their long-term targets, and hitting those long-term targets means certain reductions, and so they've spread them out over years and ratcheted the quota down. So yeah, it's built into the legislation. There's processes to make them stronger or less stronger, but all of
Yeah.
these things.
Yeah.
Um,
And
so
but is there some idea that if we do this, we achieve, quote unquote, net zero 2050, or what's the context that the legislation decisions were made in? Or is
yep,
it more political? What's
we'll
feasible?
talk we'll talk net zero when we talk about voluntary carbon markets. This is
Okay.
purely a reduction in emissions.
Yeah.
Goal is to reduce emissions, right? And it's a tool for reducing emissions. And it's a tool that, in almost all cases where it's been tried, has been shown to be successful, right?
Hmm.
Sulfur dioxide, EU emissions trading system, California, all are doing what they're supposed to be doing. By putting a price on carbon, it forces companies to make a decision. Do I want to emit, which costs me money? And it used to not cost me anything, so it didn't matter. I could emit as much as I wanted to. Now it costs me money.
Hmm.
Money lost or money not made. In both cases, it's money. And so, that forces people to make decisions and to be more efficient. And it has worked, I think.
Mhm.
Most of the criticisms you hear are about the second type of carbon markets.
Yeah, let's hold off on that for a second. I get that. I just want to probe a little bit more. There must be some there's a context about, if we want to reduce emissions, let's say California, and we're going to go after the utility industry because that's where a lot of the emissions are. There must be a presumed goal for the increasing or the decreasing cap or the decreasing quota, that if we actually do that, we will achieve some degree of progress toward solving the climate crisis, right? And I'm just trying to get a sense in your view, like, do the legislators say, well, it's impossible to get to net zero, but at least we're making progress. So I guess another way of asking my question is, how comfortable should the fact that these markets exist make us as a solution to the climate crisis?
Well, ask yourself, what is the alternative? Is the alternative no reductions in
No,
emissions?
I grant you this is better than nothing for
Yeah.
sure.
So, take California example. The cap and trade is a tool in a broader bill that says California is going to reduce its emissions to try and address climate change, right? And they set targets for themselves, and California has consistently decarbonized per unit of GDP or whatever measurement you want to have, and it's becoming more and more efficient. The idea is that this also makes alternatives to fossil fuels more competitive
Right.
because now fossil fuels have an extra charge on them, right? And so, California, as a result, has transitioned a lot towards renewable energy and, certainly away from coal, towards natural gas as a transition fuel, towards renewables as a longer term solution. And,
Hmm.
depending on how you feel, maybe nuclear is in there too, or geothermal or some other thing. Um, so it's doing that. That's what it's doing. And this is what
Hmm.
we're asking every government to do, right? Like this is what we want, apparently. And so it's a tool to do that,
Hmm.
my view,
Hmm.
right? You do need those targets. You need government to set those targets. In a
Yeah.
regulated market, it's not like a market in pork bellies. The
Right.
government's creating the demand and it's creating the unit and it's creating the commodity out of what used to be a public good,
Hmm.
the
Hmm.
atmosphere, right? It's saying, no, 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 we got to manage that public good. We're going to set limits on the use of that public good. And this is what we're going to do. So that's what interests me is that we're creating these mechanisms for internalizing that carbon externality into the economic system, sending the right signals to, producers and consumers in the economic system, through that putting a price on a ton of carbon. And in a way, you can think of this as a market for ecosystem services in, atmospheric climate regulation or whatever.
Mm.
Um,
But I think it's important the distinction between putting a price on carbon through a tax and having a cap that ratchets down over time. The ratcheting down as opposed to immediately starting down is just as a way to allow industry to adapt and be pragmatic about it. But the goal would be that the quota would go to zero if we're in excess of 350 parts per million, I assume.
Yeah. And obviously there you need the political backing to get to zero,
Right.
right?
Right.
And I'm not sure anywhere we've got that entirely because that means no more fossil fuels, so we need to transition radically, and that's a massive cost,
Right.
and a massive cost that will be borne by everybody in the economy, and people are not um, necessarily willing to do that just
Yeah.
yet.
Yeah.
Um, so
Let me
yeah.
let me ask one other question before we move to the allowance market and the controversy there. But another question that comes up for me is I guess you'd call it the equity question. If we allow price to determine um, who gets to emit emissions, in a sense, that will allow the most profitable businesses to emit the most emissions, which isn't necessarily the socially desirable outcome. So now with AI, the you know the tech companies are going to be making billions of dollars, and so that will move emissions into AI data centers and out of quote poor people's houses, um, or heating for poor people's houses, quote unquote poor people's houses. So how do and an example of this we saw happen in France with the Yellow Jacket revolution. I think that was on a tax, wasn't it? A petrol tax?
In France, it's usually about agricultural subsidies. But yes,
Yeah.
it's
So,
all.
but help us understand the issue, the equity issue, and how you think about that.
Yeah, so yes, right. This cap and trade system is saying we're going to take historic emitters and we're going to ratchet you down. And you were emitting something, and now you're going to be emitting less. And we're going to give you allowances to emit less. That allowance is being given in that first instance to the emitter. So there is a certain amount of inequity, but we all use these services, right? Like this is powering California's electricity. This is powering what all of us use. Um, you know, in a way, whether it's a tax or a cap and trade, it's putting a value on carbon, which is going to be raising the price on these things in some way, shape, or form. There's a reason why California is a little more expensive in terms of energy than some other states that we could name, because they're trying to send that
Oh,
signal.
does that explain why gasoline prices in
It's
particular
not
are
the
higher?
only thing, but there are the taxes and cap and trade probably
Yeah,
explain the
yeah,
majority of it.
yeah.
Um, uh, so, you know, that's kind of what we would want as ecologists is we would want the transition that direction. So I see this as a maybe not the perfect social equity approach, but more viable political approach to reducing the emissions. Um, and so for me, I'll take that because
Mm,
I do think the alternative is not doing anything. So if you compare Texas or somewhere else, we're not seeing that, right? Like we're not seeing that push to the transition. What we are seeing in places like Texas and other places is that renewable prices have come down. And so people, for purely economic reasons, are putting up renewables at a
right,
greater rate than they were before. So Texas leads in wind because it's cheaper now
right,
than, coal in some cases.
right, right.
So
But
that's
there,
what
it seems to me there's a there's a there's the issue that this is raising prices, and the context is the affordability crisis, and so this makes this all politically very tricky. It's essentially the reality of no longer being able to pollute the atmosphere for free,
yeah.
and no one wants to pay for it. But then there's a second layer, which is the allocation, not among not the overall price rise for the entire economy, because the entire economy runs on energy, but the participants in the market that will be able to pay the most for or be able to afford to pollute the easiest are going to be the industries that are the most profitable.
Mhm.
And so the technology industry is more profitable than the utility industry, even though the utility industry is where a lot of these emissions are. And so doesn't this mean that the our choice of where we're going to use these quotas is going to be determined by the profitability of the sector and not by some democratic analysis or estimate of what is the greatest social good?
Yeah, look, we live in a system where markets decide some of these things, for better or for worse, and I don't see that's a change from the
Yeah.
system we currently live
Same
in.
as the price of a real estate in Nantucket.
Yes.
Yeah.
Uh, if we could get to a political system where everybody gets together and makes decisions on where we want to head, then other options would become available. But I don't see that happening just yet. I see
Yeah.
us moving rapidly in the other direction.
Right.
And so, I'm glad that people like the EU and California are countries and states have done this because I do think it puts a price on carbon. And it is a recognition that, we have been subsidized by nature in our economic system to a great degree.
Mm.
When the subsidies end, prices will have to go up, and that's what it should happen, right?
Right.
We should be seeing that cost internalized into our economic system. I think what everybody's fighting for is, at least some of these companies, is not to bring that price in, charge anybody but me kind of thing. Uh,
Hmm.
but it's not the way it's going to work. This is going to be inflationary no matter how you think about it,
Right.
right?
Right.
Whether it comes in the form of ecosystemic collapse that disrupts the cocoa markets and the fuel markets and everything else, or whether it comes in the form of a carbon tax, both are inflationary,
Yeah.
and we will see both. Either way, I just would prefer a much more organized transition towards better
Right.
alternatives, which I think this helps us get to. And
Yeah.
I'm not saying we can't use taxes because I think you can do both, right?
Yeah. Yeah.
Countries have done both.
Yeah. Well, and the extension of the point you just made is if you actually, I think the estimate of ecosystem services that Bob Costanza and his team last did puts the number, and this is not putting any value on what's sacred. This is just literally the material benefits. It's bigger than the economy, right? I forget the number, but it's bigger than the global
33
economy.
trillion, I think it was, or somewhere in that
How
range.
much?
33 trillion, I think
Yeah.
it was. Something.
So, you don't need to be an economist to figure out that if you're getting the value of the entire economy plus for free, and then you suddenly price it into the economy is not going to make money anymore. uh, and we've
Yeah.
got big trouble. So let's switch gears quick to because we're going to run out of time. Talk to us about the allowance market as opposed to the regulatory offset market.
So actually, the allowance market is the regulatory market.
Sorry, yeah, I had it backward. Yeah.
The voluntary carbon markets are very, very different, right? In voluntary carbon markets, there is no government forcing people to reduce. It's purely voluntary. Now, these started actually before the regulated markets. So, they started in the late 90s, early 2000s, the voluntary markets, and they informed the regulated markets. Part of we got the regulated markets because voluntary markets paved the way in some ways. And
Mhm.
California's system draws heavily on the voluntary market that existed before it. Um, in the voluntary market, people are doing it for a variety of reasons because they want to contribute, because they want PR, because they want, to be able to say that they are doing something good for the environment, or because they've taken on a net zero commitment. This is where net zero comes in.
Mhm.
Um, and an important thing to understand about the difference between these two markets is that the regulated market is about $900 billion of transactions globally. And almost every country you care to name has one of these. So in the US, it's in California and in the Northeast, the thing called RGGI, the Regional Greenhouse Gas Initiative. China has it, Colombia has it, EU has it, UK has it. There's a many,
Vietnam, I just read.
yep, a number of these emissions trading systems. They transact over $900 billion if and depending on whose numbers you're looking at. Meanwhile, the voluntary market at its peak 3 years ago,
Sorry, just a question on that. On the European market, is there one European market,
yes,
including the non-Euro countries?
I believe so. I mean, don't quote me on that.
Okay.
I believe so. I think if you're in the European Union, you're in that market.
Okay.
Uh, uh, anyway, the voluntary markets at their peak 3 years ago transacted maybe 2 billion, maybe 2.5 billion, somewhere in that range. They are now, as a result of Guardian articles, John Oliver type pieces, all of these things, they're probably closer to 500 million to 700 million. So literally, the regulated markets are 1,000 times bigger than the voluntary markets. Now, the voluntary markets are or sorry, 100 times.
100 times, I think.
No, no, not no, 1,000, 900 billion to less than a
A,
billion.
a trillion, a trillion to a billion.
Yeah.
Okay.
Um, uh, and so um, voluntary markets started off, it was the Wild West. It was like, yeah, I reduced emissions, pay me for it. I want to do something good. Yes, I'll pay you for it. People realized early on that's not going to fly. We need standards. We need to be able to say, yes, this is truly an emission reduction. So a lot of standard setting bodies have emerged in the voluntary market. The biggest one is now called Vera. It used to be called the Voluntary Carbon Standard, but there are now literally dozens of these. Um, and what a thing like Vera does is it essentially says, well, what constitutes a real emissions reductions or offset? How do we measure? How do we know? And so they build methodologies, and there's methodologies for different types of projects. So there's a methodology for reforestation, and a methodology for avoided deforestation, a methodology for forest management, a methodology for reducing methane emissions, a methodology for, burning CFCs and reducing emissions that way. Anything you can imagine, they try to come up with a methodology. And in fact, it's an open source system. Anybody can propose a methodology, but it has to pass muster through the standard system. And the standard says, all right, what makes a real credit is that it's real, we can measure it. It's verifiable, so a third party can go in and verify it. There is no double counting, so we need to register it, and say that, you can't sell it twice. Um, and then the real big ones are additional. And this is an important thing to understand in the voluntary carbon markets, is this concept of additionality. What additionality means is essentially that that reduction would not have happened but for the carbon that money in the carbon market. Because if it would have happened anyway, then you're not reducing, right? It's not really an offset because it would have happened anyway. So that's not, net.
So how does that work with, say, avoided deforestation?
It's tough, right? Because you're trying to prove a counterfactual, and it's why additionality is probably the biggest discussion in
Mm,
any carbon market.
mm,
Now, the standards say there's a lot of different types of additionality. One of them is regulatory additionality, i.e., if the government makes it illegal for you to cut down a forest, you can't claim to be protecting the forest.
mm,
It's illegal for you to cut it down, so you don't meet the standard of regulatory additionality. There's also financial additionality, which says if it is already more profitable to put up a solar panel than build a natural gas plant, you can't claim credit for putting up that solar panel. It's already profitable. It's not
mm,
additional. And
mm,
this is an interesting case because under Vera, when it was not more profitable to put up a solar panel, 20 years ago, you could get carbon for it.
mm.
When it became more profitable, Vera revised the standard and said, now you can't.
Right. Which
It's
makes sense.
it's no longer additional.
Yeah.
So it's another thing. These standards are evolving and changing and what have you, right?
But the deal that was done prior to the change, that deal's done. It doesn't get undone.
Yeah, because
Yeah.
it wasn't as
Yeah.
profitable back then, and they installed the solar even though it wasn't as profitable, so they got the
Right.
carbon. So that carbon
Right.
is not there, right? Um, I think if we try to, get into let's make the perfect, it will be the enemy of the good in this case. Because if you
Mm,
had told me before these voluntary carbon markets that we would have gotten $2 billion from companies voluntarily to, you know, pay for emissions reductions, I would have said, yeah, no way. And yet we did that. We got to more than $2 billion, and it's down now, and it's probably going up to another a billion probably this year. But anyway, it is a way to get these reductions. And what really bothers me sometimes is that how we attack the people who are using this entirely voluntary system, but we don't attack the people that are not doing anything,
mm,
right? And all the studies do show that the companies that are involved in the voluntary market that are buying offsets tend to be the ones that are reducing the most in their sector. And
Mm.
it makes sense, right? Like you don't get into this voluntarily and pay money voluntarily if you don't actually care or want to see a reduction. And ideally what companies would do is do something that is known as follow the mitigation hierarchy. And the mitigation hierarchy says first avoid the damage. Whatever you can't avoid, minimize. And then whatever you can't minimize, that's when offsets or mitigation come in.
Hmm.
Big criticism of the voluntary carbon markets is that people aren't doing the first two things. They aren't avoiding or minimizing. They're just jumping straight into offsets. I don't actually think that's true. I think most of the people that are out there are actually doing all three,
Hmm.
or at least trying to do all three. Um, and there's a lot of studies that bear that out, which I can share with people if they want. Um, but now we
In
have,
part because it's profitable to do it.
yeah,
Yeah.
exactly. And sending that signal, right? The market is sending that signal. It'll
Yeah.
cost you money. So better minimize whatever you can.
Minimize before I have to go buy these damn things.
Exactly.
Yeah. Yeah.
Uh, and they're measuring and they're minimizing, and
Yeah.
that's the process of net
And
zero.
isn't Microsoft kind of the leading corporate
Probably one
by
of the
far?
biggest for sure.
Yeah.
Yeah. And we've seen a reduction in the people involved in the voluntary carbon market as a result of all these accusations, because basically, what's in it for a company to put their head above the parapet and get involved in
Right.
the market if they're just going to get attacked, sued, played on John Oliver or what have you? There's no incentive.
Right.
So
Right.
the people that remain are the people that are actually
No good deed goes unpunished.
kind of, um, and so they are avoiding and minimizing to some degree. I agree that we should hold them to that. And in fact, as a result of these questions on integrity in the carbon market, what we've seen is the creation of two meta standards. One is called the Integrity Council for the Voluntary Carbon Market. The other one is called the Voluntary Carbon Market Integrity Initiative. And I'm aware it sounds like a bad Monty Python skit, uh, you know, uh, but um, Integrity Council for the Voluntary Carbon Market, what they do is they um, try and say, is that offset methodology good and real? And is it measuring something real? And is it well done? And so they certify the standards. So they're a meta standard. They stand above the standards and they say, this passes muster, this doesn't pass muster, this passes muster. And they've been going through that process. Um,
Mm.
VCMI is on the other side of that, the demand side of carbon. And they're looking at corporates and saying, are you measuring your emissions correctly? Are you avoiding and minimizing first and then buying offsets? And if you are, then we'll put a seal of approval on you. And if you're not, we won't.
Hmm.
So, there are efforts to try and fix all these things. Um,
And you think they're at the very least well-intended, high, there's integrity even if it's hard and not perfect. Is that your perspective
my
on it?
sense. Yeah, that's my sense. And the other thing I believe is that all this talk about climate finance in the UN and countries and how we're going to, put money and send money down to developing countries and what have you. If you go and look at like communities in Africa and Asia and Latin America, and I visited many of these projects all over the world, that climate finance isn't reaching these communities. At most it gets stuck in a capital city. The place where that climate finance is actually reaching some of these communities is through this mini tiny voluntary carbon market.
Yeah. Yeah.
It is actually
I
getting.
know of one of those projects in Panama, a reforestation project, and I must say I learned enough about it to be impressed at how complex and particular the approval process is. Like they have to remove the cattle, but they can't just send the cattle to the ranch down the road because of the additionality point. I mean, it's
That's
quite
called that's
rigorous.
called leakage,
Yeah,
John.
leakage. Yeah, yeah, yeah. So,
Yeah.
um, I knew this was going to happen. I want to get your perspective on beyond carbon before we open up the question. I'm sure we'd all like to hear like the example of your favorite carbon project, but I'm afraid we'd use up the time if we did that. So let's flip to broadening the concept to ecosystem services.
Yeah.
Where is that happening first? What do you think about it? What are you worried about, et cetera, et cetera.
So there's a number of experiments in broader markets for ecosystem services. They are happening in terms of biodiversity, and they go by different names. They are happening in terms of water. There's even some crazy things happening in other respects, but let's focus on those two because those are the other two biggies in my view. I think water is going to be really, really interesting because there's water quantity, there's water quality. It's very different from carbon. Carbon is nice because
Uniform. Yeah.
it's a uniform thing, it's a global thing,
Yeah.
it's a natural commodity or a natural currency. Water, it's not like that, right? So you see these markets for water quality emerging in a lot of different places in Australia, in the US, and a few other places. Um, and they focus on emissions to water like nitrogen or phosphorus or something else, or they focus on quantity, water quantity, and you have see funds being set up and other things to protect ecosystems that deliver water value. Um, it's different. It's growing, it's emerging. The other one is biodiversity. It's at a very early stage, I'd say, where carbon was maybe 20 years ago, because it's even harder from
Mm.
many respects. There is no natural commodity here. Some people have tried to come up with mechanisms that focus on biodiversity net gain. In other words, you go in and you say, here's what the biodiversity looks like. Is there a net gain in species? Because biodiversity is genetic diversity, species diversity, and ecosystem diversity, and some focus on different aspects of that. Um,
Mm.
Interestingly, the US has had what I call a biodiversity market for many years. It's just called mitigation banking. And it
Oh,
came
yeah.
out as a
Yeah.
result of the Clean Water Act from the
Yeah.
1970s, and
Yeah.
the section in the Clean Water Act, Section 404 of the Clean Water Act, which says you cannot harm a wetland that is considered of national importance. And the definition of that is becoming interesting. Um, and the mitigation banking says, all right, we're going to give oversight to the system to the U.S. Army Corps of Engineers. If you harm a wetland of national importance, you need a permit from the U.S. Army Corps of Engineers. In order for them to give you a permit, they're supposed to follow that mitigation hierarchy and say, first avoid, then
Mm.
minimize, then you
Mm.
can offset or mitigate. Um, and you can mitigate yourself on your own land, or you can buy from somebody who's mitigating in the same watershed, right?
Mhm.
You can't damage in California and mitigate in New Jersey. It has to be in the same watershed.
Mm.
So if you're going to damage a wetland, to get a permit from the Army Corps of Engineers, you need to essentially find somebody that you can buy these mitigation credits from um, in your watershed. It's a massive multi-billion-dollar market in the US. It's not small. Um, and it's enforced differently. So the Army Corps of Engineers in California enforces it differently than the US Army Corps of Engineers in,
Mm.
somewhere else. Um,
Much less the Army Corps of Engineers in China.
yeah, exactly. So, and you know, this has been transacting. People have been essentially creating or enhancing wetlands, turning them into wetland mitigation banks. They get a number of credits, they charge for those credits, and then they have to protect that wetland in perpetuity forever. So an acre of wetland mitigation can cost hundreds of thousands of dollars. Now, that's a strong signal. If you're a Walmart and you're going to damage a wetland and you need a permit, and the Army Corps of Engineers in your area is enforcing this,
Mm.
you have to think, is it worth it to do that?
Mm.
Or can I just find somewhere where I'm not going to be damaging a wetland?
Mm.
So again, it's sending that signal. Um,
Mm.
it's not seen as a biodiversity market, but in fact it is at the
Yeah,
end.
I never thought of that. That's interesting.
Um, and a lot of places have learned from this. Australia has different biodiversity markets. Um, the latest and most interesting one, in my view, is the UK. The UK has created a biodiversity net gain system, which is essentially like the mitigation banking system, but for biodiversity. When you're building or expanding, you need to, offset any damage through some net gain. And there's now companies emerging that are doing that. There are voluntary biodiversity markets emerging, where people are buying, there's a thing called the Jaguar credit
Oh
in
yeah.
Ecuador, and it's a very, kind of like bespoke but interesting. They're using blockchain to do traceability on it.
Yeah, yeah,
There's
yeah.
all kinds of experiments. There's 1,000 flowers blooming everywhere in terms of this, but it's a hard one. It's a hard one for us to figure out. But what I like about it, and I hope they'll learn the lessons, both good and bad, from carbon, um, it's just it's going to be a tough one to do, and it's going to be much more localized rather than global.
Mm,
Apart from, some very interesting voluntary systems that emerge,
yeah.
but there's going to be a lot of regulatory systems that emerge in that respect.
It just makes my head spin to think about the complexity of biodiversity that is diverse itself in so many different places. Um, it does make my head spin. I think, Ricardo, this has been a super, in a very brief time, super clear um, educational brief. And I think you would agree that, as you said at the beginning, these are actionable things we can do today to move the needle in the right direction. The data on the outcome of whether it's carbon emissions in the atmosphere or biodiversity loss, we don't really know what it would have been without all this. It would have been worse, but it's still horrible. And so it sort of begs the question, do we have a viable plan? And I don't think we disagree on that. And I'm super grateful for you digging in and working in the weeds of this because it's just the acronyms alone drive me nuts. But
Yeah, they drive me nuts too. So it's not just you. Yeah, I think, my take on this is, look, we need to do something to slow this down. We need to send the signals to massive amounts of capital to change the way they're thinking about this. Whatever way we can send those signals to slow it down and push in the right direction is good. And what they say is, you you don't go into battle with the army you wish you had. You go into battle with the army you have.
yeah,
And this
yeah,
is the army we have right now, because I
yeah,
wish too we had better policy. We had, wonderful economic system that was much more aligned with your book on regenerative economics. I
yeah,
wish to God we had those things,
yeah,
but we don't. And, what
yeah.
do we do now?
I had before I open it up and bring other voices in, I was playing with, I think it was Gemini. Uh, I thought you'd enjoy this, and I prompted it to say, in neoclassical economics, we have externalities, and environmental economics says put a price on blah, 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 or set cap and trade markets. And in regenerative economics, blah, blah, blah. And so I essentially said, um, I forget the question, but it was, which is there a way to think about the two choices? And here's what it said: the verdict. If the goal is to sustain the current industrial growth model, pricing externalities is the only tool available. If the goal is long-term survival within planetary boundaries, then pricing is likely a diversion that keeps us trapped in the same Newtonian logic that ignores entropy. So
Clearly, you
with
had
that,
Gemini read your book.
yeah, right. Tuned to my book. With that, we have a little time left. So anyone want to share your thoughts, comments, questions with Ricardo? I gotta switch my thing so I can see you.
I have a quick question, please.
Yeah,
Thank you. Ricardo, John, thank you very much for the discussion. I am appreciating the stacked mitigation, minimize, offset type of hierarchy that you talked about. I'm looking at other alternatives that I've been seeing and that I've been following in Europe, focusing specifically around insets and the insetting market, right? And wanted to get your thoughts around, how can this help change the system that we're currently working in, specifically in the supply chain activities that organizations can make the real change
Yeah.
instead of spending that instead of taking that capital and putting it into the offset market. How can they take some of that capital and put it back into their own supply chains, and looking at the regeneration of their supply chains, where it actually goes down to the farm level. And through that, I'm seeing that there could be the real change that we're looking for, specifically not only in carbon, but in water, in biodiversity that you've just, talked about. And I've been following some of the teachings of the Savory Institute for a long time, and I've seen the benefit of that. So wanted to get your take in terms of how can we supplement with what we currently have and add sort of insight to the current structure of our thinking and our execution.
Yeah, yeah. So insetting is an interesting concept. What it's basically saying is, the difference with offsetting is that it's doing it in your supply chain. So, what you're doing is you're reducing in your supply chain. So if you want to think about it from the greenhouse gas protocol, it's buying an offset from your scope 3, or scope, basically scope 3 in most cases, emissions. The thing is, you're going to need to do many of the things that offsets already do, right? You're going to need to measure your own emissions, understand where the emissions lie in your scope 3, which in and of itself is tough. And then you're going to have to say, is this real? Is it verifiable? Is it additional? So you're essentially going to be trying to create a credit that meets all of those standards. Otherwise, it won't be credible within your supply chain. But I'm all for it. And I think it's great. And companies get a double benefit because they're reducing their scope 3 emissions at the same time, right? So I think a lot of companies are interested in it because it also does, PR for them within their supply chain. They're sending money into their supply chain and, making friends in their supply chain, as it were. So I think we'll see a lot of companies do this for a number of different reasons. But I think where people say is that this solves all the problems. Actually, it doesn't. You still have to do the same kind of measurement if you want these insets to be credible. And you have to understand how they're being generated. What are the methodologies for counting? What are the methodologies for ensuring additionality and all these other things? And I actually think we're going to learn a lot from the offsetting market in how we do insets.
Correct. No, I appreciate it. Thank you very much. Yeah.
Hey, Tonya,
Hey,
nice to see you again.
John. Good to see
An
you
old
too.
colleague.
Yeah. So I work at Michigan State University at the Center for Regenerative Agriculture, and we work a lot with supply chains on the question of insetting. And I just wanted to come back to something that Nitesh, did I say your name correctly? Oh, okay. Said where instead of it being an externalized thing or an extractive thing where GM is buying a carbon credit generated by a farmer in Iowa, it's actually investing directly in your supply chain to have more insets. So maybe it's Nestle investing in a farmer that is a supply chain provider. And in that way, they're making a capital investment in the resilience of their supply chain. And that can't be accomplished with carbon credits or not in as direct a way. I agree with you. All of the same things about measuring, about methodology, like those things all exist and have to be reckoned with. But I'm interested in your perspective on how that maybe bridges some of these socioeconomic concerns, because often these farmers in rural places are also in some of the most economically depressed places. So if we can get these companies to reinvest in their own supply chains, can't we also help rural economies along the way and help with carbon mitigation?
Yeah, I think so, but I think both can accomplish that, right? Like I think offsetting can do the same if done properly. So, I do think it can invest in rural economies, it can invest in developing countries, and it has. Um, you know, um, there are the same issues that apply in terms of making sure the money is actually getting to the people in that supply chain in the right way and into communities in the right way. So I think done correctly, in my view, they're mostly the same from an atmospheric perspective. From the perspective of the companies, obviously, you want to work with people you're already working with. That has a lot of benefits for you as a producer, and also a lot of benefits for you in terms of like making your supply chain more resilient. So I think a lot of companies will go that route. I guess my one question would be, if it costs you double to inset than it would to offset, is that the best use of resources? Like, could we get 2 offsets for 1 inset in that scenario? Then maybe we should be, getting the most reductions that we possibly can per dollar. But that's neither here nor there. I think if a company does either of them, I'm happy because it's sending that value, that signal that carbon has a value, and it's investing in real things and real people on the ground, which I think is good.
Let's ask Jessica, Cassie, and Emily to all share your thoughts or questions briefly, and we'll give Ricardo a chance to wrap it all up with a single answer, a holistic answer.
Sounds great. I didn't hear you speak about the EU nature markets roadmap. I may have missed it, but would love to hear your thoughts on how that could shape, of course, both the nature markets, but I've also been sort of thinking about how the VCM and the regulatory carbon market are ratcheting up their approach on water and biodiversity, either in a premium or kind of the CCP labels. Kind of curious if these markets might merge at some point in some way.
Yeah. Should we hear all 3 questions?
Yeah, go ahead, Cassie.
Mine is about, I made a comment in the chat about this Amazon creating rain that then becomes the snow in the Sierra snowpack that then feeds the agricultural industry in California, which is 13% of global agriculture production, which is pretty amazing. And I'm wondering if there's a lever to pull within what you've been talking about to connect those 2 massive dots for legislators and or private sector, big ag, anybody.
Fragmentation of reductionist responses. Emily, go ahead.
Yeah. So I don't know if this is in your bailiwick at all, but I'm just wondering if there's been any work in risk pricing and the insurance industry, whether there is an increase in systemic risk pricing being incorporated in the cost of insurance that backs any kind of investment.
Yeah. 3 great questions. So let's take them in order. The EU nature system, EU has been, trying to innovate in lots of different ways. So watching the EU closely, because I think it will have impacts on all of these things. They are looking at building biodiversity markets. They are looking at regulations and disclosure around impacts on biodiversity. One thing to watch that I think will influence it and influence a lot of things out there is the Task Force for Nature-Related Financial Disclosure, which is TD. It's the sort of sister to the TCFD, the Task Force on Climate-Related Financial Disclosures. But they are coming up with this whole methodology for understanding dependencies on nature and on biodiversity, and that for companies and different types of companies. And that I think is going to influence the EU, but also influence a lot of other systems out there. I think the UK biodiversity net gain is also another one to watch in that regard, because I think it'll be pretty influential. I think the EU's approach, some might criticize it as overly bureaucratic and overly disclosure based, but I think it's useful to see how that's panning out and how the different countries will actually implement it or not in different ways, and whether they will settle on a metric for biodiversity in any way, or whether they'll follow the biodiversity net gain approach, or whether they will atomize into kind of more industry-based dependency language at the end of the day when it comes to kind of how it gets enforced. The second question on water, I think you're correct directionally, not necessarily geographically. I don't think the Amazon is we're going to find that it affects largely California, but we will probably find that it affects largely the Midwest. I think the rain in California is coming more from the Pacific side in many ways, but maybe I'm wrong. I think the real point is that we don't understand the big water cycles the way we need to. And, that lack of understanding of these massive cycles on which we all depend is problematic, because I think no matter how you cut it, the Amazon and rainforests are changing hydrological systems absolutely throughout Latin America. So Argentina, Brazil, everywhere in Latin America. Most likely in North America and Midwest and places like that. But also at a bigger degree in other places around the world, not necessarily in the US. And understanding that cycle will be super important. I just don't think in our society where we live and have, nation states that can't seem to agree on much of anything, that we were going to have that kind of level of cooperation to do that. But I do think, carbon markets and biodiversity markets, to the previous point, may end up kind of kludging together, and they already have. When you hear nature-based solutions, what a lot of people are talking about is how these natural biodiversity systems fit into carbon trading and carbon markets. I think in an ideal world, it would be a lot of different values from nature, and we would be understanding and, measuring and trying to understand how we protect those values in some way. But I think we're going to have to build the system piecemeal as we go in some ways. In terms of insurance, how long do you have? The other class I teach at Brown is literally risk, finance, and the environment. And we talk about insurance, credit rating, and the risk systems, which are broken in so many ways. The way we've kind of come up with the risk metrics in our financial world is based on, if you want to put it mildly, gambling, how we understand dice games, card games, games. There's a wonderful author called Nicholas Nassim Taleb, who wrote Black Swan, Anti-Fragile, all these things. He calls it the ludic fallacy, ludos being Latin for games. And the fallacy is that the world we live in is not a dice game. You don't know how many sides this dice has. And so trying to take a probabilistic approach to what may happen in the future is
based on what happened in the past
is totally ridiculous, right? A, it's not going to look like the past. And B, it may not be a 6-sided dice. It may be a 10 billion sided dice. And you will never understand those probabilities. And in fact, he says the world is dominated by these black swans, which are unpredictable by definition and massively impactful. And in that world, you can't guess at what the probability is. You can't measure the risk. And in my views, what that tells you is, let's not spend tons and tons of time trying to figure out the right number for the risk. Let's understand these risks are out there and they're big and they may hit us in a massive way through a black swan, and let's be ready as we can, right? Let's become less fragile, to use his terminology. He uses the terminology that says you have fragile, something that breaks when impact hits it. Teacup, you drop it, it breaks, right? You have things that are robust, they don't change. A rock, you drop it, nothing changes in the rock, right? And then you have anti-fragile, which is things that get better when they get impacted, and as a result of risk and probability. And anti-fragile things are usually systems, not individuals. And nature is anti-fragile because evolutionarily it gets stronger when it faces unpredictable and risks, right? As a system, not as individuals. Individuals die, but the system gets less anti-fragile. Muscles are anti-fragile. Again, not the cells themselves. The muscle complex gets stronger. Some of the cells die as the muscle system gets bigger and better. And so how do we move into thinking about fragility and anti-fragility in these systems, I think is important. The insurance industry is still stuck in the modeling approach in many ways, but they are seeing this, right? And they're being impacted massively by by what's going on. Their response, because they write contracts on a yearly basis, is to get out of the market. And they can do that. But that risk doesn't disappear. It just gets transferred onto different shoulders. And so when the insurance company gets out of the market, the risk is still there in the homeowners and in the state and the government. Ultimately, governments are the insurers of last resort. And we're seeing this in California. We're seeing this in the Midwest. We're seeing this in Florida, right? You know, California has the FAIR Plan, which went insolvent after the LA wildfires. So what do they have to do? They have to assess a fee on every person that is insured in California in order to make it solvent again. And they face adverse selection because who's on the FAIR Plan? Anybody who couldn't get insured by the private sector. And who are the people that can't get insured in the private sector? Those that are most at risk. So California has this portfolio of adverse selection of the most at-risk things. And so the government is footing that bill, and we're all footing that bill. And I think what we need to do is kind of manage, again, this transition and sort of, whether it's a managed retreat, and people don't like that word, but like, how do we say some places, super high risk? You only go there if you're willing to accept and take on and shoulder that risk. And some places, you know, let's figure out how to, you know, make things stronger. So harden homes, harden roofs, fireproof as much as we can, manage wildfire in different ways. And insurance, you know, certainly property and casualty insurance is not fit for that purpose in many ways. And government and insurers are going to have to work together on this because at the end of the day, they're the ones that are most affected. So as you can tell, I could go on and on about that, but
Ricardo, there was a perfect segue or transition into the urgent need for regenerative economics, which is based on complexity, not based on complicated. And all of our efforts and all of our models are not designed for complexity. So well said. And this conversation could go on and on, as you just said. I think what I would invite anyone who wants to continue the conversation is to bring it onto the platform, the With Life platform. We might even be able to entice Ricardo to dial in and offer his thoughts there as well. So please do that. And a special thanks, Ricardo, for your time and expertise. This was really enlightening for all of us. Gives us some hope, but also gives us a reality check on how far we have to go, even without dealing with the near-term political chaos happening in the United States right now. We've got a big challenge ahead of us. So
yeah,
I like the metaphor of we got to go to battle with the army we have is a great way to keep this in its place. So thank you for that.
great. Take care, you all. Pleasure.